The median 50-year-old in America has $67,000 in their 401k. Not $600,000, not $250,000, $67,000. The average, by contrast, is over $1 million. Both of those numbers are technically true. One of them describes a real person. One of them describes a math problem created by a small group of outliers who are dragging a number so far into the stratosphere that the whole conversation about retirement savings in this country has become functionally useless. And in about 4 minutes, I am going to show you the third number, the one that actually tells you where you stand, because it comes with a side of information the standard retirement savings headline never includes. Specifically, it comes with a calculation of what happens to your savings position when you add the forces that are actively working against it. Right now, in 2026, this video is about benchmarking. It is about understanding where the median 50-year-old actually stands, not where the financial media makes it look like they stand, and not where the person in the retirement fund commercial stands either. The one at sunset on a sailboat who apparently solved all of this with a certificate of deposit in '97. I am going to show you the actual numbers, explain why the comparison most people use to measure themselves is mathematically broken, and give you a framework for knowing whether your position is genuinely okay or genuinely on fire. Think of your retirement savings like an iceberg report. The part everyone talks about the average is the visible tip that billionaires and extreme outliers push above the surface. The median is where the actual mass lives. And then there is the waterline, the invisible part that most retirement coverage never touches, which is all the forces that are slowly melting both the average and the median from underneath. That is what we are here to calculate. Let me tell you about Marcus. Marcus spent 22 years in corporate HR. He was always the guy who made sure everyone enrolled in the 401k on their first day. He maxed out his own contributions most years, felt good about his balance growing, and when he hit 50, he Googled average retirement savings at 50 and felt fine. A little behind, maybe, but generally fine. The problem was that Marcus compared himself to the mean, the average, and the average at age 50 is being pulled toward the ceiling by a relatively small number of people: tech executives, finance professionals, physicians with multiple decades of maxed out tax advantage accounts who have balances so large that they warp the entire distribution. According to Empower's data from January 2026, Americans in their 50s have an average retirement savings balance of $1,020,838, and the median is $438,866. That is not a rounding difference. That is a gap of nearly $600,000 between what the average looks like and what the typical person actually has. Marcus was measuring himself against the $1 million number. Most people are nowhere near it. Here is the thing with averages. The mean is what we typically think of as average, and the median is the middle value in a range of numbers. When we look at retirement savers, the enormous wealth of individuals can make our overall retirement savings appear healthier than they actually are for the typical American. This is not a small distortion. The average retirement savings for all families is $333,940. The median is $87,000. And only 5% of households with retirement accounts have $1 million or more saved. 5%. Those 5% are doing a very effective job of making the other 95 feel like they are approximately on track. Now go deeper. Because the Empower data captures people who use a financial dashboard, people who are, by definition, more engaged with their money than average. Investors who use online financial tools tend to be particularly engaged in saving for retirement and other financial best practices. So that 438,000 median is itself slightly inflated relative to the full population. When you look at just 401k data from Vanguard, which covers all participants, engaged and disengaged, for the 45 to 54 age group, the median 401k balance comes in at around $67,796. That is a far cry from the average, which is $188,643. $67,000 for a 50-year-old in a 401k, A mid $60,000 401k balance is far from enough to sustain investors in retirement. Using the safe 4% withdrawal rate, such a balance would only provide around $2,700 per year, or a little more than $200 a month. That is less than one tank of groceries a week. You think the problem is that people are not saving enough, but that is only half the problem. The deeper problem is that people are measuring the wrong number and thinking they are doing better than they are. In a few minutes, I am going to show you why even the people who are well above the median may be dramatically less prepared than they think, because there are forces operating on their savings right now that virtually nobody is accounting for. But first, let me explain why the Fidelity benchmark, the number most financial planners use, makes the average picture look even worse. Fidelity, which manages more retirement assets than almost any institution on earth, says you should have 6 times your salary saved by age 50. Using Fidelity's guidelines, you should aim to save 1 times your salary by age 30, 3 times your pay by age 40, 6 times by 50, 8 times by 60, and 10 times by age 67. Let us run the math against real numbers. In the first quarter of 2025, median weekly wages for workers in the US were $1,194, translating to a monthly income of $5,174 or $62,088 per year. 6 times, that is $372,528. That is the Fidelity benchmark for the typical American worker at age 50. The median 401k balance for that age group is $67,000. We are not talking about being a little behind. We are talking about being 82% below the benchmark on the only account most people are counting on. Now, before this turns into a doom spiral, there is a legitimate counter-argument worth acknowledging. Not everything that counts as retirement savings shows up in a 401k. Some people have pensions, particularly government workers and some union members. Some have brokerage accounts, real estate, small business equity. The 401k number alone understates total retirement wealth for a meaningful subset of households. But for the vast middle of the income distribution, the people in the $60,000 to $90,000 household income range, the 401k is the primary vehicle. And by that measure, most people are behind. There's a man I know, retired now, who spent his entire career in manufacturing in Ohio. 41 years on the floor, never missed a day. His company had a defined benefit pension, which meant he did not obsess over his 401k balance the way corporate employees do. When the pension plan was frozen in 2008, he had about 14 years left to work, and suddenly had to build the kind of balance from scratch that his colleagues had been accumulating since their 20s. He got to retirement with a meaningful 401k and his pension, and was genuinely better off than most people his age. His 401k alone looked modest. His total picture was solid. The lesson is not that the numbers are meaningless. The lesson is that the numbers require context that a single account balance almost never provides on its own. Stay with me, because what comes next is the part the retirement savings conversation almost never gets to. And it is the part that changes your entire read on whether you are actually okay. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Most people, when they think about retirement planning risk, think about one thing: not saving enough. You think X is the problem, but actually Y is the problem. And why is this? More than half of workers, 58%, retire earlier than they planned, usually due to unforeseen circumstances, according to research from Transamerica Center for Retirement Studies. The median age, they call it quits, is 62, 3 years shy of the traditional retirement age of 65. Not because they want to, not because they hit some fire number and decided to spend the rest of their life on a beach, but because something happened that took the decision out of their hands. Of those who retired early, most pointed to health-related reasons, 46%, followed by employment issues at 43%, and family reasons at 20%. Just 21% said they retired early because they are financially stable. Read that again. Only 21% of early retirees chose it. The other 79% had it happen to them. And then consider this. According to the 2025 EBRI Retirement Confidence Survey, the median expected retirement age among workers is 65. The median actual retirement age among retirees is 62. That 3-year gap has persisted for decades across multiple surveys. Here's why this matters for your math. If you are 50 right now, your plan probably assumes you keep contributing for another 15 years, maybe to 65. But the data says there is a better than even chance something interrupts that timeline by at least 3 years. 3 years of missed contributions, 3 years less of compound growth, 3 years of potentially drawing down assets you had not planned to touch yet, and 3 years before Medicare kicks in, which creates its own financial problem that we will get to in a moment. There's a small company in New England, a mid-sized manufacturing firm, that went through a round of layoffs in the spring of 2023. 12 employees in their late 50s were let go. All of them assumed they would find comparable work. Of the 12, 4 did within a year. 3 took jobs at significantly lower pay. 5 are now essentially retired, spending down savings, collecting Social Security earlier than they planned, and paying for private health insurance out of pocket. None of the 12 had planned for that scenario. All of them had told themselves they would work until 65. That story is statistically unremarkable. According to a survey by the Transamerica Center, 58% of retirees left work sooner than planned, and most for reasons beyond their control. This is why I think about the 58% rule, not as a statistic, but as a planning parameter. If you are 50 years old, you should model 2 scenarios. One where you work until 65, and one where you stop at 62. Not because you want to stop at 62, but because that is what the data says is more likely than you think. Here's what I built and why it changes the math. Knowing where you stand in the savings distribution is one thing. Building a system around that knowledge, one that accounts for a forced exit, the Social Security timing puzzle, the healthcare gap before Medicare, and the sequence of returns problem is a completely different project. I built a digital book called The Exit Code to work through exactly that. It is built on 50 years of actual retirement data, not opinion. And the core of it is a mathematical framework that turns maybe someday into a specific date. The 2 elements most directly relevant to what we are talking about right now are the 58% rule, which outlines the buffer strategy for people who need to plan for an exit that happens earlier than scheduled, and the $14,000 invisible bill, which is the insurance gap that quietly destroys the retirement math for people who stop working before 65. That second one landed harder than any other number when I was building the framework, because it is a cost that is almost completely absent from standard retirement projections. You can get the exit code through the link in the description for less than 1 hour with a mediocre financial advisor. Every year you wait on this, math compounds against you in a way that is not dramatic and is not reversible. Now, let us talk about the third force working against your position right now, and this one is operating, whether you are behind, on track, or ahead. Based on the Social Security trustees' best estimates, the Old Age and Survivors Insurance Trust Fund will be able to pay 100% of total scheduled benefits until 2033. At that time, the fund's reserves will become depleted, and continuing program income will be sufficient to pay 77% of total scheduled benefits. That is not speculation. That is the official projection from the people who run the program. Upon insolvency, Social Security is legally required to reduce outlays to match revenues, which would result in an across-the-board 23% cut in retirement benefits. If you are 50 years old today and you plan to claim Social Security at 67, that is 17 years from now, the trust fund depletes in 7. The math already does not work without a congressional fix. And more than half of Americans who have not retired yet, 52%, say they expect to rely on Social Security benefits to pay their necessary expenses once they exit the workforce. The people who are most behind on savings are also the most dependent on a system that is currently on track to pay 77 cents on the dollar in 7 years. There is a worse wrinkle inside this. For most people, there is no advantage to claiming Social Security early to get ahead of a future benefit cut. An across-the-board reduction hits whatever benefit you are already receiving, regardless of when you claim. Claiming at 62 permanently cuts your monthly benefit by around 30%, and a future reduction would compound on top of that smaller base. So the instinct to get out early before the cut actually puts you in the worst mathematical position possible. You lock in a smaller base and then take the haircut on that smaller number. Someone expecting $2,000 a month could see that drop to roughly $1,440 to $1,540 under the current 2033 projection. For someone whose primary income in retirement is Social Security, that is a meaningful collapse in standard of living. And for the people in the bottom half of the retirement savings distribution, the people with the $67,000 median 401k balance that Social Security check is not supplemental. It is the retirement. This is where it gets really interesting, and also where it gets quietly expensive, in a way that most people never calculate. There are two forces that work on your retirement savings that almost never make it into the benchmark conversation. The first is advisor fees. The second is the healthcare gap. Let me give you both. On fees, a 1% difference in fees and expenses reduces your account balance at retirement by 28%, according to the Department of Labor. That is not a rounding error on a spreadsheet. That is over a quarter of your money. Run the specific math. If you have $500,000 in retirement savings and pay a 1% fee, you could lose more than $250,000 over the next 25 years. That $250,000 is not being taken from you in one moment. It is being extracted at the rate of about $27 per day, every day, invisibly in the form of compounding that never happened. According to a 2021 study by Advisory HQ, the average financial advisor fee is 1.02% for $1 million in assets under management as an annual fee. If you are paying that fee on a $500,000 balance, which most people in their 50s who work with advisors, or the math above applies directly to you, the reason fees matter more than almost any other variable at age 50 is timing. The 15-year rule says to aim to reach a coasting point by age 50. If you can aggressively overfund your accounts now, the compounding effect over the next 15 years can potentially double your balance, even if you have to scale back contributions later. But if a 1% fee is siphoning off a chunk of that compounding every year, the doubling effect gets quietly shaved. Every year you pay a 1% fee on a growing balance is a year where compounding is working for your advisor's revenue stream as hard as it is working for your future. Now here is the one that people never see coming until they are standing in front of it. If you retire before 65, which again, the data suggests 58% of you will do whether you want to or not, you are not eligible for Medicare. Estimated average monthly benchmark premiums escalate to $1,072 at age 62, $1,101.80 by age 63, and top out at $1,120 for those ages 64 to 65. That is before deductibles, before copays, before a single prescription. And it just got worse in 2026 specifically. From 2021 through 2025, enhanced premium tax credits reduced costs for marketplace enrollees across most income levels. Those credits expired at the end of 2025. The subsidy cliff is back. Federal help cuts off above 400% of the federal poverty level, which is roughly $62,600 for a single person seeking coverage in 2026. Early retirees drawing from investment accounts can land just above that line without much effort. And if they do, their annual premiums could more than double compared to 2025. Anyone earning above that level pays full price premiums, which for a 62-year-old can exceed $1,500 a month. 3 years of that before Medicare kicks in, even at the subsidized rate of $1,072 per month adds up to $38,592 in premiums alone. Add out-of-pocket costs, and you are looking at potentially $50,000 to $60,000 in healthcare spending between 62 and 65. That is completely absent from most people's retirement projections. And here's the kicker that lands this entire conversation. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. Add pre-Medicare years on top of that. This is not a minor line item. This is a six-figure obligation that sits invisible in the standard retirement savings benchmark. Marcus, the HR guy from the beginning, eventually figured this out. He had been measuring himself against the average savings number, feeling moderately okay, and had never run a calculation that included the full healthcare picture from 62 to death. When he did, his "I am basically fine" feeling turned into "I need to rethink the next 15 years." Not panic, not disaster, but a real recalibration of what fine actually means. "I thought I was doing well," he told me. "I had $400,000 in the 401k and a house that was mostly paid off. But I had never thought about what would happen to my savings rate if I got laid off at 60. And I had never added up healthcare from 62 to 65. The subplot of this video is actually Marcus's story, because Marcus is not one person. Marcus is the largest demographic group in this conversation. People in their late 40s and early 50s who are engaged enough to have been saving, but who measured their progress using a broken benchmark and made decisions based on a picture that did not include the waterline. Let me now run a mini case study with specific numbers to make this concrete. Say you are 51. You make $85,000 a year. You have $350,000 in your 401k, a small brokerage account worth $40,000, and a house with about $200,000 in equity. You are above the Vanguard median for your age group, below the Fidelity benchmark of 6 times salary, which would be $510,000. You feel okay. Here's what the waterline calculation looks like. If you contribute the maximum to your 401k for the next 14 years, $32,500 per year, with the catch-up contribution with an 8% annual, return your balance by 65 would be approximately $2,100,000. That sounds good, but if you are paying a 1% advisor fee the whole time, and that fee shaves roughly 28% off the final balance, leaving you with approximately $1,512,000 instead. That is not the end of the world, but that is a $588,000 difference between you and someone investing in low-cost index funds with no advisory fee. Then subtract the healthcare picture. If you get forced out of work at 62, as 58% of people do, you spend 3 years paying roughly $14,000 per year in premiums before Medicare. That is $42,000 that comes out of your early drawdown, instead of staying in the account to compound. At 8% over 15 years, that $42,000 leaving your account at 62 is actually worth about $133,000 of future portfolio value by 75, gone. Then add the Social Security question. If you claim at 62 out of necessity, rather than waiting to 67, your benefit is permanently reduced by roughly 30%. And if the 2033 trust fund cut happens, you take that cut on the already reduced base. Someone who expected $2,000 a month at full retirement age claimed at 62 for $1,400, and then takes a 23% cut in 2033, gets approximately $1,078 per month. From that starting expectation of $2,000, this is not a story about catastrophe. It is a story about the gap between the benchmark you are probably using to measure yourself and the actual math of your situation. There is a retired couple in Arizona I know who did everything right by the standard metrics, maxed out their accounts, owned a nice house, hit the number the financial planner told them to hit, retired at 63, and then spent the first 2 years watching their savings erode faster than projected because they had not fully modeled the healthcare costs, the early Social Security claim, or the sequence of returns risks that hit them during a volatile stretch in 2022. Not destroyed, but uncomfortably behind where they expected to be. They read every newsletter, they had a financial advisor, they had done the work, and the stuff that hurt them was in the parts of the plan that most advisors do not spend a lot of time on. That is the amused disappointment version of this. Not the system is rigged, more like the system is optimized to discuss the parts that are easy to put in a brochure. Financial advisor says you are going to need 1.46 million to retire comfortably. Client says, great, how do I get there? Advisor says, contribute to your 401k and invest in a diversified portfolio. Client says, perfect. Neither of them discusses the healthcare gap, the Social Security timing puzzle, or the fact that the 1% fee they are paying will quietly remove 250,000 of those dollars from the compounding stack over the next 25 years. The conversation is complete. The plan is incomplete. Now you are asking yourself, okay, what do I actually do with all of this? Here are 3 practical takeaways, and I am going to make them specific to this topic, not generic invest more advice. First, stop benchmarking against the average. The average retirement savings for Americans in their 50s is $1,020,838. The median is $438,866. The average is being pulled by outliers with balances that have nothing to do with your situation. The median is the right comparison. And even then, the most useful comparison is the Fidelity benchmark of 6 times your specific salary, not a national average. Know your number. 6 times your salary by 50, 8 times by 60. Run that math today with your actual income, not some national average. Second, model the forced exit scenario explicitly. More than half of workers retire earlier than they planned, usually due to unforeseen circumstances. Run a version of your retirement plan that assumes you stop working at 62, not 65. See what that does to your Social Security benefit if you claim early. Calculate what 3 years of private health insurance costs before Medicare. If that scenario breaks your plan, you need to know that now, while you still have time to build the buffer. If it does not break the plan, you sleep better. Either way, you are working with the real picture. Third, calculate your fee drag. Find out exactly what percentage you're paying in advisory fees and fund expense ratios on your retirement accounts. Then use the Department of Labor's own math. A 1% difference in fees and expenses reduces your account balance at retirement by 28%. On a $500,000 account, 28% is $140,000. If you can get the same asset allocation broadly diversified, low-cost index funds with a total fee burden of 0.1% instead of 1.1%, you keep that money. Index funds have not underperformed active management over 30-year windows. The fees have not earned their keep. The math is on the record. Over half of American households, 54%, report having no dedicated retirement savings, according to the Federal Reserve's Survey of Consumer Finances. Yet, the total 401k savings rate remains steady at 14.2% in the fourth quarter of 2025. These seemingly contradictory numbers indicate that the gap between non-savers and savers is growing. If you are in this video, you are in the saver group. That is real. The gap between people who engage with this and people who do not is going to widen considerably over the next decade. But being a saver is necessary, not sufficient. Being a saver who uses the right benchmark, models the right risks, and controls the costs within their control, that is the actual edge. Lazy investing built more fortune than crypto memes. And the average 50-year-old with $1 million balance does not exist. He is a statistical artifact created by a handful of people at the very top of a distribution who are so far from normal that including them in the same number as everyone else is basically a form of financial fiction. The real 50-year-old has $67,000 in a 401k, is probably going to retire at 62, whether they want to or not, is going to face a healthcare bill between 62 and 65 that was not in the plan and is banking on a Social Security check that has a 7-year countdown on it. That person can still be fine, but they cannot be fine by accident. Data. Empower Personal Dashboard, January 2026. Average retirement savings for Americans in their 50s, $1,020,838. Median, $438,866. Vanguard data. Median 401k for ages 45 to 54. Approximately $67,796. Fidelity benchmark. 6 times salary by age 50 per Michael Shamrell, Vice President of Thought Leadership at Fidelity. Transamerica Center for Retirement Studies. 58% of workers retire earlier than planned. Median actual retirement age, 62. Social Security Trustees Report 2025. OASI Trust Fund pays full benefits until 2033, then 77% of scheduled benefits. U.S. Department of Labor. A 1% fee difference reduces retirement account balance by 28%. Smart Asset 2026. Estimated average monthly ACA premiums for a 62-year-old, $1,072 per month. Fidelity 2025 retiree healthcare cost estimate. Average 65-year-old will spend $172,500 on healthcare in retirement, excluding long-term